Hello, very good afternoon to all, and welcome to today's Daily Dose of Market Insights. Very good afternoon. Today will be Wednesday, the 5th of February 2025. So, as usual, let's have a quick look at the disclaimer first before we kickstart our Daily Dose for today. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape yesterday in terms of news flow, economic data releases, that covers in today's early Asia session as well as the intraday performance on the broad-based cross-asset classes before we have a deep dive into the latest intraday technical analysis trends, key levels to watch for today. So we know that yesterday has been primarily been centered around trade war, global trade tensions between US and the rest of the world. So what occurrence that took shape yesterday was China actually hit back with we call it rhetoric tariffs against Trump's US 10% tariffs on China products that has taken shape yesterday. So there was no we call it delay of US 10% tariffs on China product, unlike the 25% tariffs on Canada product and Mexico products has been delayed for about 30 delayed by 30 days. All right. So China actually hit back 10 to 50% trade tariffs on US energy and agriculture tools. So this does not come in with immediate effect. So the deadline for them to come in is next Monday, which is 10th of February. So market is actually embracing some kind of trade deal optimism between China and US that could potentially be, we call it negotiated between this short period of time. And how does the market react to that? So what you see over here is that the market actually rose positively in the major US stock indices. All of them actually rallied. The SPX is up by 0.72%. The Nasdaq is up by 1.26%. The Dow Jones Industrial Average underperformed slightly by 0.3%, and the Russell 2000 also up by more than 1%. To be precise, up by 1.41%. And what's interesting over here is that the Nasdaq 100 rallied, but the rally actually stopped exactly right below our pivotal resistance that we highlighted yesterday. So for those who follow our daily dose on a frequent basis, these key levels changes every day because I cover it on the intraday basis. So yesterday we do have a kind of a bearish bias on the Nasdaq 100, but we do expect a bit of kind of a push up, and the push up tends to actually stop at this predefined 21,660 short-term pivotal resistance that I covered yesterday. And what's interestingly, after hitting that resistance, the Nasdaq 100 futures is actually in the red right now. So the Nasdaq 100 futures is down by negative 0.5% as we are speaking, and the E-mini futures is down by negative 0.4%. And so one of the reasons technically speaking, why the 21,660 got managed to actually be stopped in terms of yesterday's rally was also the lackluster, we call it earnings segment of two key high tech growth stocks in US. So yesterday, Alphabet or Google reported their earnings. So what they did over here is that, yes, overall, they managed to beat expectation in terms of their overall bottom line. But however, in their particular product segment, which is cloud sales, which is pretty much significant, fall short of expectation. And because of these cloud sales, Alphabet cloud sales fall short of expectation, the after hours share price of Google or Alphabet, i.e., declined by negative 7%. You see this huge plunge over here after the earnings is being released. So that also explain why the lackluster performance of the Nasdaq 100 futures as we are speaking, which is down by negative 0.5%. And also another semiconductor bellwether stock, which is AMD. So we know that in the last 2 years, the outperformance of the US market US stock market, pardon me, has been centered around this AI high productivity growth team play, and AMD is one of the key players for them. So yesterday, AMD, yes, overall they managed to beat expectation. Okay, reported better than expected revenue and profit, but however, the data center sales fall short of estimates. All right, so with this data center, we call it a product segment that came below expectation in the, we call it the revenue and outcome, or the sales, I would say. The AMD stock also plummeted after hours by negative 9%, okay, close to negative 9%, almost 10%. It plummeted right after the earnings that's been released in the after hours session. Right, so something to very interesting to see once the US cash market session open today at 10:30 p.m. Singapore time. Potentially, would there be any negative feedback look from this lackluster share price performance of key high growth technology AI centric mega cap stocks, which is not really mega caps. Alphabet is mega cap, but AMD is not really a mega cap stocks. But AMD is still part of a key semiconductor stock that is driving the majority of the superior outperformance of the US stock market against the rest of the world in the last 2 years or so. All right, and also in today's we call it session, US also hit back as well because of these tick for tat measures. US Postal Service puzzled suspension of for China e-commerce product. That means we're talking about people like buying products from China e-commerce platform. The US Postal Service suspended these services over here. All right. So with that, that actually causes the China we call it related stock market, which is the Hang Seng Index, to actually plummet in today's Asia session after rallying very strongly since Monday. So the the Hang Seng Index is actually down by close to negative 1%. Later, I'll touch on more on the short-term intraday technical outlook because very interestingly, it's still holding above some key short-term pivotal support level. And with that, we call it that potential so-called trade deal optimism that market participant that has some hope that the deal could be reached before 10th of February, some sort of negotiation deal to be reached between US and China before 10th of February, which is next Monday. That causes the dollar to actually plummet. All right, so I could see across the board the dollar actually sold off against the major the other major currency. So later we'll talk about more about it from a short-term technical analysis aspect of things. All right, and what's interesting over here is that yesterday we also do have two key Federal Reserve officials speaking. Fed speak in short. Fed Bostic, which is the Federal Reserve president of Bank of Alata, he actually mentioned that he sounded not so dovish. He said that it may be a while before the next rate cut. All right. So another Federal Reserve official Daly, saying that the Fed can take its time to react to Trump policy, and she do not says that she do not think that the Fed should need to preempt over here. And the key thing is that the ultimate aim is that the Fed still must bring inflation back to 2%. And in her point of view, over here is that, let me highlight. So it's a rather not so dovish speak as well. The San Francisco Fed chief also said that the job of bringing inflation down to 2% has not been finished, and she was devoting 100% of my energy to that task. So it actually subtly implies that inflation or sticky inflation pressure is still in the US economy, and the Fed, in her opinion, Fed Daddy is saying that the job has not been done yet for bringing inflation down to 2%, which means, i.e., the Fed is likely to be less much dovish in 2025 as compared to 2024, and that is so being expressed by another Federal Reserve official, Fed Bostic, saying that the next rate cut could be a while time. All right, so overall, that actually has also implication from a long-term fundamental and intermarket dynamics, which is this particular chart I want to share with you guys, is the forward-looking inflationary expectation of the market participants in the US Treasury inflation protection securities market have on the view of inflation pressure in the US 5-year from today and 10-year from today. So if you look at the blue line, the dark blue line and the light blue line, the dark blue line is the 5-year break-even inflation rate. That means, i.e., in short, what is the inflation 5 year from today? And the light blue line is the 10-year inflation rate expectation from today. Right, so this is more forward-looking, as being implied by the U.S. Inflation Protection Securities Market, TIPS in short. So traders in this market continues to actually price higher inflation expectation down the road, and very clearly it starts to shape a bullish breakout after they have slowly trend down since the last 3 years from the high of March or 2022. All right, in the last 3 years, that's going to be trend down. And what you could see over here is that the movement of the 5-year break even and the 10-year break even move hand in hand with the longer term 10-year US Treasury yield. All right, over here. So recently, the 10-year US Treasury yield has started to push back down, but with the 5-year and the 10-year break even rate continue to inch higher, it may exert upside pressure on the US 10-year Treasury yield to continue to trend upwards again. And bearing in mind that the US 10-year Treasury yield is considered as a longer-term cost of funding globally as well. Why? Because long-term long-term loan products like property loans, whatever, more or less has a direct, we call it, use the US 10-year Treasury yield as a risk-free rate, as a benchmark to price these longer-term loan products. So with the 10-year US Treasury yield showing potential of inching upwards, because it has a direct correlation with the 5-year and the 10-year, and the 5-year and 10-year has clearly been breaking out from this previously major downtrend phase and shaped a series of higher high and higher low and broke out above this descending trend line as well over here. So it means that the 5-year and the 10-year break even inflation expectation will exert upside potential pressure on the 10-year US Treasury yield. So when the 10-year Treasury yield has starts to pick up steam again, inching upwards, that could actually see a liquidity tightening condition in the US economy and globally, and that could be favorable for the US dollar in the long term and unfavorable for various risk assets like equity. All right, so this is something to look out for, and I believe that the US Federal Reserve official is also watching this 10-year and 5-year break even as well, because do not forget, these are future inflation rate expectations. So if future inflation expectation get entrenched to the upside, very hard inflation may start to go down to their desired 2% target. So i.e., in a nutshell, very likely the Fed will be less dovish as in 2025 compared to 2024. So potentially market is looking at only 2 interest rate cut in 2025. But if the inflation expectation going to push up higher, that means the 5-year and the 10-year continues to inch up to 3% level, that 2%, that potential 2 interest rate cut that is being priced by the Fed funds futures market may only be 1 or even no interest rate cut at all for this year. All right, so something to actually take note of from a longer term fundamental and intermarket dynamics that I share with you all for today on this break even uh, inflation that has staged a major bullish breakout as we are speaking right now. All right, so with that, also sum up the data point that I want to share with you guys over here. Okay, one more data point to share with you all is early today's Asia session. There's this key China data, which is the Caixin Services PMI data that was out in early Asia session today. Yeah, Caixin Services PMI. So the Caixin Services PMI data actually so-called slide down slightly below expectation. Market is expecting 52.3. So from 52.2, that was I think a 3-month high. It actually went down lower to 51. All right, in the month of January over here. So what we could see over here is that means economic growth activity in China, especially the internal economy, which is where services is part of it. That means it's part of consumption spending, has starts to be rather lackluster over here. All right, so if you look at the 3-year trend, okay, it could go sideways over here. So what it means that given this potential trade tension between US and China that is still on, it may continues to actually be rather fluid, and potentially if it start to turn worse, the China policymaker has no choice but to actually ignite more forceful fiscal stimulus to address this ongoing weak consumer sentiment that is still inherent in the Chinese economy. All right, so with that, let us now turn our focus to the next segment of our daily dose of market insights, which is the intraday technical outlook on the various broad-based cross asset classes, starting with the FX market first. So I'll mention these are intraday levels that I share, trend that I share potentially will only last for today. So tomorrow there will be a brand new, we call it levels to take note of. All right. So let me expand my screen so that you guys could have a better view on the chart. Okay, good. So let's start with the FX market first. So on the FX market, the euro dollar yesterday, we do have a bearish bias below the 20-day moving average. So it actually broke above the 20-day moving average on the start of the US session, and thereafter is try to trade sideways from here. So it seems to us that there is some form of a residual upside momentum that has crept back into the euro dollar pair. That means potentially extending this Monday mean reversion rebound condition. So on Monday we do have a mean reversion rebound scenario. It hit our resistance. Then thereafter, yesterday we flipped back to a bearish bias, but the bearish bias didn't work out and pierced above the 20-day moving average. Pardon me. So with that, we got to respect this ongoing short-term positive momentum that is still inherent in the euro dollar. That means potentially we may see some kind of we call it higher probability that this ongoing mean reversion rebound scenario from Monday low may extend. All right, so with that, I will have a rather tight short-term pivotal support level for today, which is the former minor swing high of 4th of February yesterday that got stored during the Asia session and during the start of the European session, but managed to break through during the start of the US session. So this might become a significant pullback support level, and previously there was a clear signs of a significant reaction at this level as well during the 15th of January period and 21st of January period. You could look at how the price action react off from this level, okay, in the last 3 weeks or so. So last 2 weeks or so, pardon me. All right. So let us use 1.0345 short-term pivotal support level on the euro dollar. So we will flip to a intraday bullish bias for today for a potential extension of this mean reversion rebound scenario, a minor one, because the medium-term downtrend phase still remains intact on the euro dollar. Next near-term resistance level to watch will be very close to the 50-day moving average, where it got rejected since the end of January. Now acting as a key near-term resistance zone, confluencing with a key graphical zone area as well at 1.0440/1.0460. And in terms of Fibo retracement, if you retrace down the previous sell-off from 27th of January all down to way to Asia session, this Monday Asia session swing low, it corresponds to the 76.4 Fibo retracement level. Only an hourly close below 1.0345 will revive the bearish tone and invalidate the mean reversion rebound scenario for today to allow the potential bears to take a much more stronger foothold, exposing the next near-term support level at 1.0270. A breakdown below it potentially sees 1.02 figure/019 next, which is our medium-term pivotal swing low area or support area at 13th of January. Right, so that's for the euro dollar. Now turning our attention will be the sterling dollar. So the sterling dollar hit our short-term pivotal we call it a resistance level and didn't break above it, which is the 50-day moving average. So for today, I will have a neutrality stance instead. So neutral between 1.250/2520, and the lower limit of the neutrality zone will be close to the 220-day moving average, now acting as a pullback support at 1.2380/1.2345 next. So flipping to a neutrality stance for today on the sterling dollar. So neutral between 1.2520, lower limit 1.2380/1.2345. So that's for the sterling dollar. Now turning our attention next will be the Asia Pacific dollar pair against the Aussie dollar. So the Aussie dollar also rallied up and now come close to this effect reacted off or stopped at the 6250/6280 short-term pivotal resistance that we have yesterday as well. So with the 50-day moving average still acting as a resistance level, all right, close to the 6250/6280. So with that, this level here, because it hasn't broke above the short-term pivotal resistance, and the RSI now has starts to inch back down below the overbought level after hitting the slight overbought level yesterday. So with that, will still maintain that intraday bearish bias, but the odds of this bearish bias will increase potentially if we start to see a breakdown of this key intraday near-term support level at 62.25 over here. 62.25, we're also very close to the 20-day moving average that is acting as a key near-term support level as well. So an hourly close below 62.25 potentially increase the odds of the bearish bias to be revived, exposing the next near-term support level at 61.65. Below it sees Monday swing low at 60.90. However, an hourly push up above 62.80 will potentially retest the minor swing high, the swing high area of 24th of January, which is also our medium term pivotal resistance level at 63.30 next. So i.e. in a nutshell, still maintain that intraday bearish bias using 62.50/62.80 as my short-term pivotal resistance level. But however, price action got to break down fast below 62.25 to increase the odds of today's bearish bias. Right, so that's for the Aussie dollar. Turning our attention now will be the dollar yen. So the dollar yen continues to remain weak below the 20-day moving average. And right now, as we are speaking, at the end of towards the second half of the European session, or towards the second half of the US session, pardon me, it finally broke down below the 50-day moving average over here, and also the minor range support level that was in place since 27th of January. If I could draw a trend line for you guys to see right over here. Okay, so right now it actually plummeted and hit our support level that we mentioned yesterday. Yesterday we do have a bearish bias 153.20/152.90. Okay, already hit this level, and given that the RSI now is in the grossly oversold level, much more oversold than the previous level of 16th of January. So now it's almost close to a 3-week lower of oversold level. So given this grossly oversold level on the hourly RSI, and being hit on the 53.20/52.90 and as well as the 200-day moving average, there could be some form of a bounce. But what you could see here, there's no bullish divergence on the RSI. That means, i.e., this bounce may not transform into a deep, a mean reversion, kind of a deeper rebound at this point in time. So what we will tend to do over here is that potentially we will look for the bounce, where this potential bounce may end, and potentially where we may start to revert back into our bearish bias mode again after this bounce has hit some key intraday resistance level. All right, so the first resistance level to watch will be definitely this pullback line here over here. All right, let me put it in proper writing in. Okay, this level here. Okay, at 15410, 15410. All right, 15410. So this 15410 here is the key intraday first resistance to watch. Maximum will be the 50-day moving average at 155 figure level, which I will be using as a short-term pivotal resistance level rather than a short one at 154.90. So it could be a zone between 154.10 and 155 figure level. So as long as the 155 figure level didn't actually been surpassed to the upside, prices float around this area here, potentially we may still maintain our intraday bearish bias on the dollar yen. The next support level to watch after 152.90 will be at 151.90 level. So 151.90 level also correspond to this ongoing minor medium term descending trend line or descending channel, pardon me, from the high of minor descending channel lower limit from the high of 10th of January, and as well as correspond to this graphical congestion area of 12th of December and 13th of December last year. Okay, only the push up with an hourly close above 155 figure level will invalidate today's intraday bearish bias to kickstart a mean reversion rebound scenario again on the dollar yen. Next near term resistance level to watch will be at 155.85 followed by 156.70. So i.e., in a nutshell, given this grossly oversold hourly RSI condition, potentially the dollar yen may see a bit of minor bounce first during the start of the European session. Key resistance level to watch on this minor bounce scenario, 154.10, maximum 155. So as long as 155 figure didn't surpass to the upside, what was the order 155 short-term pivotal resistance that I have for today didn't surpass on the upside, we will still maintain that intraday bearish bias on the dollar yen, given its current technical condition that short-term technical intraday condition that I have just highlighted on the dollar yen. Now, with that, let us take a look at one interesting FX cross pair that I want to highlight to you to watch as well. Will be the Aussie yen. So the Aussie yen, very clearly, it really starts to trade below the 20-day and the 50-day moving average over here, and also residing inside this medium-term descending channel that is still in place since the 7th of November high. All right, over here. So with that, I'll be using a 96.85 short-term pivotal resistance level to maintain to have a intraday bearish bias on the Aussie yen. One of the interesting cross pair I want to highlight to you guys. Near-term support level to watch will be this Monday low at 94.70. A breakdown below 94.70 exposes 93.60 level. So 93.60 level is in fact the minor swing low of 11th of September last year. Only a hourly push up and a close above 96.85 short-term pivotal resistance will invalidate today's intraday bearish bias on the Aussie yen to see a squeeze up towards the upper limit of that medium-term descending channel. The next resistance level to watch will be at 97.60, pardon me, which is the downward sloping 50-day moving average. Above it sees 98.20, which is the upper limit of that medium-term descending channel. All right, so this is one of the interesting cross pair. Technical configuration to watch will be Aussie yen with 96.85 as my short-term pivotal resistance level to maintain that intraday short-term bearish bias on this Aussie yen cross pair. All right, so with that, that sum up the short-term intraday technical outlook on the FX market for today. Now let us now turn our attention to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33, yes, today it actually plummeted down over here because of that tick for tat measure coming from US, where the US puzzle, we call it services suspended those we call it e-commerce platform, Chinese e-commerce platform puzzles that to be sent to US customers. So that causes the Hong Kong 33 to shape that negative reaction in today's Asia session. So what I could see over here is that it hasn't broke below our short-term pivotal support yet, which we have yesterday or since Monday at 20,170, which is also the lower limit of this ongoing minor ascending channel that is in place since 10th of January. Right, so still no change, still using 20,170 as my short-term pivotal support level. Maintain the intraday bullish bias. First resistance level to watch for today will be at 20,980. Only a breakout above 20,980 exposes the next near-term resistance level, 21,320/21,390, which is the upper limit of this minor ascending channel. One-time Fibonacci extension from the low of 10th of January, and graphically the minor swing high area of 8th of November and as well as 10th of December last year. Only an hourly close and a breakdown below 20,170 invalidate today's intraday bullish bias to kickstart a minor mean reversion decline scenario, revisiting the 20-day and the 50-day moving average again that is acting confluencing with a graphical support at 19,685. Below it sees a slightly push down towards 19,350 next over here. So that's what will be the Hong Kong 33. Still using 20,170 short-term pivotal support level to maintain that intraday bullish bias. Now onwards, next will be the Nikkei 225 or the Japan 225. So the Japan 225 continues to trade below the 20 and the 50-day moving average. So with that, we still maintain that intraday bearish bias on the Japan 225. Still recall that the Japan 225 from a medium-term perspective, it continues to be trapped within this sideways complex range since 27th of September. All right, this kind of complex sideways range. So it's more like a range within a range situation right now on the Japan 225. So using 39,310 or 39,310 as my short-term pivotal resistance level, which is slightly above the 20-day and the 50-day moving average, still maintaining that intraday bearish bias on the Japan 225. Near-term support level to watch will be 38,410, followed by 38,140 next, which is the minor swing low area of 13th of January and 17th of January. Only a push up and an hourly close above 39,310 invalidate today's intraday bearish bias to kickstart a potential push up towards the upper limit of this complex sideways range configuration that is still in place since the late September 2024. Next resistance level to watch will be 39,710 / 39,830. Above it sees 40,360 next. So that's for the Japan 225. Onward next will be the European stock market, which is the German 30 or the German DAX. So the German 30 and the German DAX continues to be rather lackluster. Yesterday performance was lackluster, still hovering below the 21,625 short-term pivotal resistance that we highlighted yesterday, and the hourly RSI also starts to actually shape a push down over here. What we could see below the 50 level mark again. Let's start shape a push down. So it means a kind of a lackluster upside momentum on the very short term basis. So for sure, no change. 21,625 short-term pivotal resistance level, maintaining that intraday bearish bias. Two key near-term support level to watch for today: 21,290. Below it exposes the minor swing low area of 27 of January and 3rd of February at 21,100, also conversing with the upward sloping 20-day moving average. Only a push up with an hourly close above 21,625 will invalidate today's intraday bullish bearish bias, will invalidate today's intraday bearish bias to see a squeeze up to revisit the current all-time high area at 21,820. Above it potentially sees the next resistance coming in at 21,960 / 21,990, which is the one-time Fibo extension. Right, so in a nutshell, still using 21,625 short-term pivotal resistance level to maintain today's intraday bearish bias on the German 30 or the German DAX. Okay, now next will be the US stock indices, starting with the US Wall Street 30. So yesterday, the US Wall Street 30, we do have a bullish bias. The first resistance at 44,670 that was made during the start of early Asia session. Then thereafter it trade down, and on the onset of the US session, it tried to actually retest 44,670, but can't came very close to it, and now did a what you call it, a negative, slight negative retracement of it from here. So with that, we will turn into a neutrality stance for today, because it may start to go into a very sideways range configuration for today for US Wall Street 30, which is the Dow Jones Industrial Average, neutral between 44,670 and 44,095 level. All right, so turn into a neutrality stance on the US Wall Street 30 between 44,670 upper limit, lower limit 44,095. Okay. Up next will be the Nasdaq 100. So the Nasdaq 100 has shaped that reaction of our 21,610 short-term pivotal resistance level that we highlighted. So what we could see over here is that the hourly RSI also has started to break down from a parallel ascending trend line. Okay, you stage a bearish breakdown, and what we could see over here is that if you put it in parallel with the price action of the raw price action of the Nasdaq 100 in parallel, the Nasdaq 100 hasn't break down yet. Okay, it's still testing this line over here. Okay, so this is something like a bearish condition, because we know that RSI is a momentum indicator, and momentum tends to lead. All right, over here. So with that, we'll still maintain that intraday bearish bias on the Nasdaq 100 using 21,610 as my short-term pivotal resistance level. First support level to watch will be at 21,125. So that was yesterday's European session low that got tested and managed to shift the bounce. Below 21,125, revisit this Monday low at 20,870. Only an hourly close and a push up above 21,610 will invalidate today's intraday bearish bias to see the squeeze up to revisit the last Friday minor swing high area at 21,845 / 945, and above it sees the current all-time high that was printed in on the 13th or 17th of December, okay, at 22,135. So i.e. still using 21,610 short-term pivotal resistance on the Nasdaq 100 to maintain that intraday bearish bias. All right, so with that, that sum up the intraday technical outlook on the major stock indices. Now our next focus will be on the commodities market, starting with gold XAU/USD. So for gold XAU/USD continues to rally as expected and almost hit our second resistance level that we have yesterday at 2,860, which is defined by a cluster of Fibo extension level, because right now the only way to actually we call it define the next resistance level is do Fibo extension clustering. All right, because right now gold is trading at a all-time high area, so there's no previous historical resistance to use as a gauge. So with that, over here, price action for today, what I'm going to do is I will tighten the short-term pivotal support level to a much tighter level. So using, because it also broke out above this parallel ascending channel, all right, taken from the low of 31st of December. That means what you could see over here is that it broke above this upper limit. That means what you are seeing right now from the low of 4th of February yesterday is now doing a bullish, a potential bullish acceleration. Okay, why? Because the hourly RSI, yes, is overbought, but there is no signs of a bullish divergence as the hourly RSI, pardon me, continue to shape higher high. Right from here. Okay, so with that, I will tighten the key short-term pivotal support level to this yesterday's minor swing high, now turns into a pullback support, which is very close to the upper limit of that former upper limit of the minor ascending channel, now turns closely to a pullback support level as well. So this will be my tighten short-term pivotal support level. Oops. Okay, let me put it in writing. 2,830. Okay, 2,830. 2,830. So this will be the next support level to watch. Okay, let me tally it up. Okay, good. So using 2,830 Titan short-term pivotal support level, momentum still remains positive. Potential bullish acceleration in place since the low of 4th of February. Maintain that intraday bullish bias on gold XAU/USD after 2,860. The next resistance level to watch will be 2,883/890, followed by 2,009/2,912, all defined by a series of Fibo extension clustering technique. Only a push down and an hourly close below 2,830 will negate today's intraday bullish bias to kickstart a minor corrective decline scenario within its short and up-term, medium-term uptrend phase that is still intact, as price action clearly trade above the upward sloping 20-day and the 50-day moving average. The next near-term support level to watch, if Titan short-term pivotal support level at 2,830 does not hold for today, will be 2,812, followed by 2,795, maximum 2,771, which is close to the lower limit of that minor ascending channel. All right, so i.e. in a nutshell, still maintaining that intraday bullish bias on gold XAU/USD using a tightened short-term pivotal support level for today at 2,830. All right, so with that, let us now touch on the last market that we tend to cover on a daily basis, will be the West Texas crude oil. So the West Texas crude oil plummeted down as expected, almost hit our second support level that we highlighted, 71.05, all right, before stepping that bounce back again, but the bounce can't surpass above the 74.15 short-term pivotal resistance that we have yesterday. So no change on these two key levels. 74.15 short-term pivotal resistance on West Texas crude oil, still maintaining that intraday bearish bias for today. A breakdown again below 72.70, revisit 71.05. Only an hourly close above 74.15 level will invalidate today's intraday bearish bias to potentially see a squeeze up to revisit the 20-day moving average that is acting as the next near-term resistance level, and the former minor swing high, the minor swing high of 3rd of February and 27th of January also confluencing at a similar resistance zone at 75.75/76.16. So i.e. In a nutshell, still using 74.15 short-term pivotal resistance level to maintain that intraday bearish bias for today on West Texas oil. All right, so with that, that sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the calendar on what are the key data to look out for today. So today will be Wednesday. So for Wednesday over here, today will be in the US, okay, pardon me, in the European session will be a rather quiet session, nothing key to take note of, because all these, right, these are actually what HCOB services PMI. These are the finalized numbers, so more or less it will be that flash number that was released about 1.5 weeks ago. All right, so a rather quiet European session for today. And the only key thing over here is there could be a European official speech. Okay, there's actually a European official speech, ECB Lane speech. He was speaking at 10 p.m. Singapore time, and Bakin will speak again at 10 p.m. Singapore time today. I think more or less will be stating the same. Sorry, it's not him, it's Bostic. Okay, pardon me. So this is another Federal Reserve official, Bakin. He will be speaking, all right, at 10 p.m. Singapore time. And the all important one will be the ISM services PMI data that is out at 11 p.m. Singapore time today. And market will be paying close attention also to the services prices, because services prices are going to inch higher at 64.4. So if this data going to inch up much higher at 65 or 66, that could also inherently increase upside inflationary pressure in the US economy, because the services prices is considered as cost of doing business in the services industry, is more like a leading inflation indicator as compared to the PCE and the CPI index. All right. Now, up next will be more pertaining to the West Texas crude oil market, which is at 11:30 p.m. The weekly EIA crude oil stockpile change that could influence the intraday movement of the West Texas crude oil. Something to look out for at 11:30 p.m. Singapore time for today. All right. Then thereafter, we have two Federal Reserve speaking in the early wee hours of Singapore time. 2 a.m. Fed Goolsbee, and 4 a.m. Fed Bowman over here. All right. So, and as well as for today, there is still two key earnings, US earnings to look out for that could impact the major US stock indices. Firstly, will be Walt Disney will report the earnings before the start of today's US session. And Qualcomm, very importantly, this could influence the Nasdaq 100, because it's also one of the key semiconductor related stocks. So Qualcomm will release its Q4 earnings at the close, after the close of today's US session. That means i.e. after 5 a.m. Singapore time, right? Something to take note of. So with that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.